Look, we may as well start. So hi everyone and welcome to our R&D webinar with RSM and Playwright Consulting. Before we start, I'd like to acknowledge the country on which we meet today. I come to you from the land of the Kombu-Mary saltwater people of the Ugamba language region and invite you to think on whose land you are residing on. Sovereignty was never ceded and the lands have always been and always will be Aboriginal land. I pay my respects to elders, past and present, and I extend my welcome to any Aboriginal or Torres Strait Islander people joining us today. So today's webinar is about the R&D Incentive. It's one of those programs that many of you may have heard about, but few actually maximize it. How do we know this? In the latest ATO report on the incentive, game developers were particularly underrepresented, both when it comes to the number of claims made as well as the value of benefits actually received. So in short, you may be leaving money on the table, and we would very much like to avoid that. So joining us today to demystify the program, touch on the eligibility criteria and explain its relationship to the DGTO are RSM's Peter and Serge from Playwright Consulting. Before I hand over to them, I'd already touched upon that, the usual housekeeping. Please mute yourself, turn the video off while Serge and Peter are presenting. There'll be an opportunity for you to ask questions once that's all done. But until then, just going to be a little bit mindful of that. So Peter and Serge, thank you for joining us today. I guess let's kick it off with the R&D Transparency Report. Peter, you've done some work on that. That's the aforementioned report that highlights that video game companies have somewhat been underrepresented when it comes to this incentive. So let's give it a go. Let's kick it off.
Fantastic. Thank you, Jens. And I will hopefully share the right screen. Excellent. That is the right screen. Just want to check, Serge.
Yeah.
Great. Cool. All right. Hello, everyone. Amazing to be here alongside Serge and Jens. As Jens just touched on, we're really, really excited to talk through this program today because we do see a huge opportunity for this industry. What we would consider a underutilization of the benefits of this program. And hopefully by talking through both the transparency reports, you can see some data today, as well as the program eligibility criteria and some of the key issues that we see. We hope everyone can get some learnings out of it and be able to get some money back to help your development going forward. For those who don't know me, my name is Peter and I'm a partner here at RSM, focusing mainly on technology-based R&D tax claims. I've got a background in accounting, law, and more recently I did an AI course with Oxford University. I lead our digital gaming group. I've been working very closely with Jens and the likes of Serge on R&D tax-related content for IGEA. As far as R&D tax goes, I was an expert witness in 2018 at the Senate inquiry into some of the laws that you see today. I work very closely with both DISA and the ATO and their senior leadership teams, so I can offer some insights into that today. I'm going to begin actually just talking to a little bit about what is the R&D tax incentive. So I do think a lot of people misunderstand this program, and that in the first instance results in a lot of people not making claims when they should be. So it's a broad-based tax incentive, so very different to a grant. A lot of people think it's a grant. It's not a grant. What that means is there's no budget limitation. It's not a competitive process. If you do the activities and you've got the expenditure and you've got the relevant documentation to support it, you get the cash, right? So it's not a case where you need to go through an approval process per se. The second thing is the benefit itself. A lot of people say, oh, maybe we're not spending enough to actually access it. At the highest level, we can get up to 48.5% refund back per every dollar of R&D spend. So even if you're doing a little bit of work that might qualify, right? As long as you meet the $20,000 minimum threshold, there's quite a bit of cash that you can pump back into the business. It's industry agnostic, so it supports new or improved technologies, products, processes, services, technologies, etc. As long as there are some technical unknowns, which we will go into, I think Serge will go into that criteria in a bit more detail in due course. But it's really not a case where it needs to be a world first piece of development or a project that's really groundbreaking. As we will see, it's an activity-based regime, which I've got in my fourth point there. Some people I speak to think it's an all-in or all-out model. They go, my project meets this or it doesn't. That's not how it works. Any project, you break it down into the relevant activities. It could be a small part of the project. It could be a big part of the project. There's something in it for most people that I talk to in the tech space. The other really quick point to raise is there are supporting R&D activities, which in the first instance, the law just says has to be directly related to a core R&D activity. A lot of people miss out on R&D dollars or don't make claims because they don't understand how supporting R&D activities work. A lot of the time, supporting R&D activities can boost the claim significantly and get you a lot more money back than what people think. My third point I've got on screen there, it is a very powerful cash flow tool. A lot of people see R&D as we finished the year, we do this process from a compliance perspective, similar to my tax return, and then we get some money back. That, in my view, is not the right way of looking at it. You should be looking at the R&D tax incentive as something, number one, that can change your cost model on exploring new ideas. If you think about it, you're going to get almost 50% back on the dollar. Now the cost of doing something is no longer $1. It's now 58.5 cents, 51.5 cents, sorry. Maths, not mathing. So then when you're looking at how do you explore different things, when you're planning out this year, next year, 3 years, 5 years, you should be working that into how you can really leverage the R&D program to boost your business and boost your projects. R&D transparency report, I'll get into this now. Most people would have seen this. So what is it? Around the 2021 or thereabouts, there were discussions around publishing a transparency report that basically outlined what every R&D claimant is claiming. Now, the idea of a transparency report for tax is not new, and for over 10 years now in the corporate tax space, certain businesses have had to publish, the amount of tax they're paying, et cetera, et cetera. So it's not a new idea. But this particular report, the idea was to really give transparency around where are taxpayer dollars going in terms of incentivizing the R&D activity in this country. Now, that is really important. As most people know, in Australia, BIRD, that's business expenditure on R&D, as a proportion of GDP has been dropping, and it's at all-time lows. So if we can see where the R&D investment dollars are going from the government, then from that perspective, we can better diagnose how we can solve that problem. Commercial sensitivities, this was a big issue at the time when this idea was proposed. Essentially how it works is there's no disclosure on your actual R&D activities. It doesn't tell you how many projects, how many activities, etc. And the report is published on a 2-year delay. So the most recent report was published on the 3rd of October 2024 for the year ended 30 June 2022. So that's more than 2 years later. What's happened so far after the report's been published? The first report that was published had 11,545 companies. At the time, a lot of people sort of looked at it and said, hey, a lot of the banks aren't in here, a lot of the mining companies aren't in here. What's going on? The reason for that partially is that there were around 850 companies with substituted accounting periods, which were not included in the report because they didn't quite meet that 2-year delay for that. So in October 2025, when we get the FY23 data, that should be a more holistic report that outlines everyone. What impact has the report had? At the time, there were concerns that advisors would start going after people and trying to take each other's clients, would say, I can get you more money back, and therefore that could result in high-risk claims. That hasn't particularly happened. The other sort of concern at the time was companies would look at their direct competitors and say, how come they're claiming so much more than me? I want to put in more of a claim, again, resulting in an increased risk level. We haven't seen that, although it could be too early. It's only been 6 months since the report's been published. At the moment, it's too early to tell, but we haven't seen any indicators so far. Other impact, there was public outcry that gambling and tobacco companies were getting R&D tax dollars. And again, once sort of we go through the criteria in a bit more detail, you'll see that the R&D tax setup, when you look at the activity-based regime that it is, it's trying to encourage people from a technical perspective to run experiments. So the actual sector it's in, so I'll use gambling as an example, it's not necessarily the, developing your gambling product that's getting the dollars. It's actually the underlying, software engineers and AI guys that might be investigating how to leverage technologies in a certain way. That is a transferable skill to other sectors across technology. That's actually getting the dollars. So some of those concerns, may be unfounded. I've spoken to the regulators, and there are increased reviews and will be more increased reviews after the transparency measures. The public just expects there to be a little bit more, robustness around reviewing who's accessing the program. This is just a sample example of the top 10 which were published. I advised 3 of the companies on this list, but as you can see here, it's just got the company name, the company ABN, and the total R&D expenditure. It's got no more detail than that. Now, some figures into the technology and gaming world. So I'll start with the small versus big business. Only 14% of all claimants by number are public and multinational businesses. 48% fall in small business, which is less than 10 million aggregated turnover, and 38% are privately owned group. That means 86% of R&D claimants are potentially in the pool to access that refundable tax offset up to 40.5%. Technology businesses were actually the highest number of R&D claims, with over 2,000 claimants at over $2 billion claimed, and an average claim size of $1 million. That means a technology business under 20 million aggregated turnover, that includes gaming companies, can receive up to $500,000 per year in refundable tax offsets based on the average claim size, right? So you can see how far that will go in supporting your business cash flow and accelerating activities. Now, some contextual information to gaming, right? And a lot of this is IGA data. Victoria, New South Wales, and Queensland have the highest number of R&D claimants when we look at the R&D report. The gaming industry has had a really tough 2024 with some well-publicized layoffs across the board. Victoria, New South Wales, and Queensland make up the bulk of gaming companies in Australia. 85% of gaming companies in Australia is developing their own IP, right? So that's a pretty critical test when it comes to whether or not one can make a claim. 56% of gaming businesses have been operating for less than 5 years, right? Operating for 5 years or less, which indicates a lot of the businesses could be pre-revenue or smaller businesses. Now, if you look at the data I sort of outlined in the first instance, right, that would indicate, based on the R&D claimant data in the technology sector, we should expect a lot of businesses to be accessing the R&D, right? Then the final point I've got there is the IGEA report indicates more than 50% of respondents indicated they would be claiming DGTO or looking to access DGTO, which means there's development activities going on in these businesses. Now, what would that indicate to us? As I said before, gaming businesses are prime candidates to access the R&D tax incentive, and typically at the 43.5% or 48.5% refundable R&D tax rate, right, in terms of accessing a refund. Now we go to the FY22 stats that have been published. Only 29 gaming companies in Australia have claimed the R&D tax incentive. Now we know there are, I believe the last data, at least 400 or 500 gaming companies in Australia. So that's less than 10% of gaming companies currently even accessing the R&D tax incentive, right? And there's only 3 outliers with over $2 million R&D claim, right? And some of these are the big players in the gaming world. 23 out of those 29 gaming companies claiming average claim under the technology average of $1 million at an average of $333,000 for gaming companies. Now that's more than 1/3 lower than your average technology company, right? Now we've got to ask ourselves, why has this happened, right? And hopefully today we're going to get through that. Serge, am I passing over to you now, or are we doing the wider company access first? I forgot the order.
This would be a good opportunity to pass over to Serge and also allow him to say a couple of words. Because I mean, it is a very good question. Like, why don't we engage more with this? And I think Serge has some of the answers.
Sure. Hello, everyone. I'm Serge. Whoops, we don't want to share. This is my 10th year doing R&D, so I can never seem to escape this space. And more recently, I guess my focus has been more on studios in the entertainment space. So basically, I'm just going to run you through some program basics, and then I'll hand it back to Peter for the complex side of things, and then we'll jump back to do some DGTO crossover. So basically, the R&D program, it's there to encourage studios and companies to invest in innovation that may not otherwise occur. I think, like as Peter said, a lot of game studios in particular probably underestimate how much R&D they actually do, because gamers tend to really actually be at the frontier of R&D. And so basically the program's joint administered, so by Oz Industry, which looks after the application and activity side of things, and the ATO that looks after the expenditure side of things. So the Tax Act is under Division 355. So basically, to be eligible, you need to be a company incorporated in Australia or operate through an Australian permanent establishment if you're a foreign company. Basically, the entity must be subject to income tax, and you have to spend at least 20K on eligible R&D expenditure per income year. So as I mentioned, the R&D activities must be registered with Oz Industry. And so the deadline for this is always 10 months after the end of the income year. So basically 30 April at the end of this current month, that's going to be the deadline for FY24. And so the tax offset is then claimed through the ATO in your company tax return. So now the value of the tax offset for the R&D depends on both the aggregated turnover and the final tax position. The aggregated turnover is the sum of all the annual turnovers for the R&D entity and related entities. And so basically the final tax position is important, especially when it comes to the refundable offset. So basically, if you've got less than 20 million aggregated turnover, your refundable offset is going to be the corporate tax rate, which is 25% for most studios kind of that we're looking after, and then plus the 18.5% uplift. So basically, if you're in a tax profit position, you're going to get a benefit of around 18.5%, which is the uplift. If you're in a tax loss position, assuming the tax losses exceed your R&D spend, and we'll touch on that in a bit, you're going to get 43.5%. And again, this is refundable, meaning it's going to be paid back to your bank account after your liabilities have been cleared. Now, if you're an aggregated turnover of more than 20 million, it's a non-refundable offset. So basically, the benefit you get will sit as a credit on your tax account. Now, this depends on your R&D intensity. So basically, if you're more than 20 million aggregated turnover, you've got some more special rules to consider. And so the intensity is your amount of R&D expenditure divided by your total company expenditure. And so basically, if you're in a 0 to 2% intensity, you're going to get the tax rate benefit. Usually for these larger companies, it's around 30%, not the 25% for the smaller companies, plus 8.5%. If you're above 2% intensity, you're going to get a plus 16.5% uplift. So now R&D activities. So you can have multiple R&D projects, and each project must have at least one core activity. And then the core activity can be accompanied by supporting activities. So now the core activities must be experimental in nature, aimed at resolving a technical unknown, and conducted for the purpose of generating new knowledge. Now that just seems like a lot of just kind of just technical wording, but really the way I like to pitch it is just like, what's your R&D story? And if you can just craft that story well, then you've got a good chance at putting it into your R&D claim. So the government loves using this word because it's in the legislation. So I've oranged it because it's super important. So basically, for a core activity must involve an outcome that cannot be determined in advance by a competent professionals, a competent professional on a worldwide basis. That's really the test. But as Peter said, I think a lot of studios kind of underestimate kind of where they are when it comes to R&D. But the most important thing is that the work that you're doing follows a systematic progression of work. So basically what that involves is forming a hypothesis, and then conducting experimentation or multiple experiments, and then observing and recording those results, and then evaluating those results, and then drawing logical conclusions. So basically, in the event of an audit, this is what they want to see. They want to see that flow between each stage. So basically, this structured approach is essential to demonstrate that the activity is a genuine attempt to resolve these technical or scientific unknowns and not just, routine development. Now, supporting R&D activities are those that can directly relate to the core activity. There's this little part where it's like, if you're producing goods or services, or if the activity that you're doing falls under an excluded category, for example, internal administration, market research, it must meet the dominant purpose test, which is just that the prevailing purpose of that supporting activity is there to actually support the core R&D. So that's the activity side. And so basically, once you've got that written up, you put it into the R&D application, and then you submit it off to AusIndustry. Now we're going to touch on R&D expenditure and some documentation rules. So companies can claim expenditure that is incurred in relation to core supporting R&D activities. There's no, there's no limit in kind of in which bucket you can fill, and must have been incurred in Australia, unless you have an overseas finding, which is an entirely separate process. So now claimable R&D expenditure includes, your salaries and wages of employees, contractor consultant fees, depreciation of assets used in the R&D process, and then a portion of overheads that are clearly connected to the R&D. Now you have to make sure that the expenditure is clearly attributed to the eligible activities. So that's super important. And so now to support your claim, I've oranged it again because it's super important, this concept of contemporaneous documentation. So basically what that means is the records created at or near the time of the R&D. So while records can be created later or retrospectively, timely evidence is super preferred by the regulators. So the two things really, if all you take away from this call is systematic progression of work and contemporaneous documentation, you've passed the test. So this is really the two pillars that the ATO and AusIndustry really attack. If you can demonstrate both, then you are what I'd consider review ready. So this is super important. So, basically good documentation shows what was done, when, by whom, and how the activity progressed through this systematic progression of work process. So useful records, design docs, test logs, experiment results, source control commits, task tracking, notes, timesheets. A little tip I like to tell everyone is, just send a little email to each other, send it to your R&D consultant with like a subject line saying, R&D test results, and just write some notes, because emails are such a good way of showing this timely evidence. Cool. I'm going to hand it back to Peter.
Cool. All right. Thanks for that, Serge. That was really, really useful. And that, I think the things that Serge has emphasized is really, really important, particularly to my point earlier around the increased review. Sorry, am I sharing the right screen? I'm just looking at this. Are you guys seeing the right screen? Okay, fantastic. My biggest challenge is the technical challenge. So I'm going to move on to now, why do company not access the R&D tax incentive based on our experience? So Serge and I will both talk to this. I've got 11 points on this screen, but Serge obviously add to it as I go through this. The first point I'll probably make is the criteria Serge has outlined. A lot of people see that in the first instance and go, oh my God, that is so complicated. There's so many words. I'm never going to understand that. And that's, I guess, what we're here for, right? R&D is a relatively niche set of laws in the tax legislation, but we deal with it day in, day out. And if you speak to someone who actually knows what they're doing, it can be simplified. Some of those tips that Serge just gave, can take you from a 90% risk level to a 10% risk level instantly, just by contemporaneously sending some of those test results, for example. In terms of moving on back to the slide, why do companies not access the RDTI? These are just the common ones that I've seen. The first one is people say, oh, we're in a loss position, so we can't utilize the R&D credits, right? Now, I believe that's R&D credits, the term used in other countries, right? So a lot of people who come from overseas, like for US, for example, you can't get a refund. So people say, well, I'm not going to go through all the process and the cost of preparing an R&D claim. I'm not making enough money to pay tax. I can't get R&D credit, right? As we've seen earlier, right? Most companies will get a 43.5% refundable tax offset back, so possibly a refund. And the limited companies that are at the 30% tax rate can actually get up to 48.5% back. So being in a loss position actually puts you in a better spot. Now, that is unless you're over 20 million aggregated turnover, which we're going to touch on the DGTO, but that's where really the DGTO will be your preferred option because you can cash that out. The second point is people say, oh, we didn't spend enough R&D money, right, to make it worthwhile. 2 points to this. The first one is a lot of people see R&D money as I've put a bucket of money aside for R&D, but as Serge outlined earlier, and again, we keep coming back to this activity-based scenario, right? You run that criteria through, let's say you look through your quarterly plans of everything you've done. You're going to find there are going to be activities that meet the core and supporting activity definition, right? And like I mentioned before, even a 20K spend, you're getting almost 10K back, right? So, any cash is better than no cash, I suppose. So not spending enough money should never really be an excuse in this area. The third one is, and I hear this one quite often, someone says either themselves or someone else previously worked in another company and had a bad experience because it took too long, right? Now, there's no one way of doing an R&D claim. There are many different ways. And, again, if you talk to someone who actually knows what they're doing, and it's documentation throughout the year, you take on tips like the one Serge just gave, it shouldn't actually take that much time, right? Where it takes a lot of time is where companies do absolutely no preparation. They get to year end, they want to make a big claim, and you're balancing the two of big claim, getting a lot of money back, but we didn't do any preparation and we didn't prepare any documentation. Where that's the case, there's a lot of work to be done, and that's typically what happens. So it should never really be a reason why you're not making a claim because you think it's going to take too long, right? If you do the right prep, it shouldn't take that long. The fourth one, again, sort of similar point, we don't have the time to focus on it right now. I've spoken to gaming companies that say, we're busy focusing on developing the game, so we don't have time to focus on an R&D claim, right? So you tie all the points that I came up, that I spoke to earlier. Number one, it shouldn't take that long. And number two, you're getting almost 50% back some of this time, some of the times when you're doing R&D claims. So, when you balance the two, it's very rarely I've seen, it not being a worthwhile exercise to at least look into and get some money back. The fifth point is probably a flip to number 3, and that is someone in the team has previously done R&D claim and had it overturned, and the claim was challenged. 2016, 2017, there was an intense crackdown on technology-based R&D claims. A lot of people had a bad experience then. I can tell you today, both DISA or Oz Industry and the tax office are a lot more collaborative and a lot more supportive of their approach. So the compliance landscape is very, very different to people that experienced it around that 2016, 2017 point, right? So it's always worthwhile, even if you had a bad experience, have another look, speak to someone like Serge and myself, just, stress test what you're doing. And we can tell you in today's compliance landscape, based on what you're doing and the documentation you keep, what is the likelihood of that being a successful claim or not. And remember, again, it's not a 100%, it's definitely eligible or it's definitely not eligible. It's always somewhere in the middle, and then you can make a educated decision. Number 6 is people say, we just do what we do. We don't really have any formal R&D projects or tracking. Once again, it obviously it's better as you move along with an R&D claim to start putting in tags and documentation and governance processes, but that is not a necessary thing to put into claim. You can just look at the activities you did in the year, even if it's what you might consider to be standard work that you do. If it meets the criteria, it meets the criteria. It doesn't matter. It's not a case where you need a formal R&D project. And again, prior to 2011, there was a formal legal requirement for an R&D plan. That requirement doesn't exist these days, and most people can get at least some money back. Number 7 is, and this is, again, a huge one, people say, we're getting paid by a customer, so it's not our R&D. Prima facie, getting paid by someone else does not mean you cannot make a claim. There are relevant tests you have to run. So the most common tests are, number 1, it can't be not a risk, which is, I won't go into all the details of that. Number 2, the R&D and the amount you incur on the R&D activities you register must be for you and not to a significant extent for someone else. Again, that test requires some looking into as to what the arrangement is. It's not a formal IP test. It's really a test around, can you commercialize the know-how you are learning through your project, even if you're getting paid by a customer. Right, and a lot of times, like I said, I do see people go, I can't make a claim, someone's paying me or engaged me to do it. That is definitely worth looking into. There's a lot of activities not being claimed where that's the scenario. Number 8, our accountant said it's too hard or risky. This again links into some of the points I mentioned earlier. It is a niche area. You do need experience in this area to really know what you're doing. A lot of accountants I do know have either done R&D claims in the past or tried to do it, but more and more these days, accountants that I know are sort of at least getting a second opinion from us or engaging us to do it. Because if you get the right person doing it for you, it is not too hard and it's not too risky. That's probably the comment I'd put out there. Number 9 is people say, what we do is not that innovative, or what we do is not what I would consider R&D, and it's just product development. Okay. Again, this is a legislative test set in the tax law. It's not a general purpose. Is this R&D or not? And a lot of people, this actually is probably both sides of the fence. People sometimes put in R&D claims because they think it's innovative or they think it is R&D, but it actually doesn't meet the criteria. You always have to go back to the criteria Serge outlined before, especially those bits he put in orange, right? It's not just you considering it's R&D or not. But on the flip side, sometimes people go, we're always trialing new technological tools to see whether we can incorporate it in, but that's just what we do, right? We wouldn't consider that R&D. But if you run the test and you've done the research and there's no guidance around how you might incorporate technological tool to your particular circumstances, potentially you could meet the core R&D activity definition. It does not mean you can't meet it. Number 10 is the same. People say, what we're doing is other people doing it. There's someone in the US that's got the same game or same sort of general concept or idea, right? The critical thing to note is those tests that were outlined by Serge, the test is based on a competent professional with access to publicly available information. So if someone else has done something, there's no published information as to how they solve that technical problem, and you do it again, to the extent you can't reasonably just go to them and go, I'll pay you a reasonable price to tell me, right? You figure that out yourself. That still will qualify in most cases. And the last one I've got here is people go, some of the work is overseas, which in gaming a lot of times that is the case because there's expertise overseas. 2 points to make on that. Number 1, just because the work is overseas doesn't mean you can't claim the Australian portion. Just you need to be careful in the activity you're registering is solely conducted in Australia. And number 2, there is an overseas finding process that Serge mentioned before, where if you jump through some other hoops, the major one being you can't access that expertise here in Australia in a timely manner, you can potentially actually include the overseas costs and activities in your claim as well. I'll pause there for a sec, Serge. I don't know if you want to add to that list.
Yeah, I think you nailed it with everything. The only one is like if I add point number 12 would be now a lot of game studios are like, oh, we have our own tax offset. We don't need the R&D. But I think the answer to that is, and we'll show you an example soon, that the R&D can really buff up what you're getting back from the government.
Cool. Okay. I think that the last one on my list was the DGTO. I think you've got another slide, possibly.
Yeah, I do have a little section, but
the complex items. So I forgot about the complex items. Okay, I will quickly just talk to some more complex. So this is probably going to be more relevant to those that are already claiming, but also there are some upfront things that you need to be aware of. So I'll just quickly jump through this to put it on the radar. The first one is the aggregated turnover test. So as Serge mentioned before, for you to access refundable tax offset, you do need an aggregated turnover of under 20 million. And again, Serge has already covered this. So, you know what, I might just skip this one. But in a nutshell, it's not just your turnover. It's basically you plus connect and affiliate entities. And sometimes there's tracing that needs to be done to trace it all the way through, because if there's at least 40% rights to income, capital, or voting power, and there's a common, let's say, investor above you, sometimes I do see issues where a fund has more than 40% rights in the studio, but also another company and a whole bunch of portfolio companies. You just got to be aware of that. Do that work up front. Number 2, documentation requirements. Again, Serge has already touched on that, so I'm not going to go too much into it, but contemporaneous documentation, as Serge said, is, the most important. There have been a lot of cases recently that have said it's not a fatal scenario if you don't have it. People have had, stat decks, that sort of thing, as long as the witness is reliable, i.e. someone that's there at the time and it's not too far after the fact. So, you know, in the Mount Owen case many years ago, there was a guy that wasn't even there, and then this was like 8 years after the activity happened. He said, "I think this is what they did," so that wouldn't work. But the second point on documentation, because I get this a lot, where people go, "You guys talk about all this documentation. Now I've got to track things in the year. That's so much effort. I don't know if I can do that. It's too much to think about." Again, it's not a black and white or 100% 0% scenario. Work with your advisor. Come up with a process that works for you, right? Obviously, the more you do, the lower the risk. The less you do, the higher the risk. But I said before, you want to meet somewhere where you are comfortable with the risk exposure for the amount of money you're getting back, right? And that will dictate how much effort you need to spend on documentation. 3, overseas expenditure. I've already touched on that earlier. 4, where the IP is owned by a foreign parent. After 2011, they did introduce these foreign-owned R&D rules where the Australian entity can be undertaking R&D for a connected or affiliate entity outside of Australia. A whole set of rules that you need to step through for that to qualify as well. But just keep in mind, it's not necessarily the case. The Australian entity must own the IP for you to make an R&D claim. The 5th one I've got there is sweat equity payments. Again, in this world, that happens often. If you're interested in the ATO tax determination, it's TD 2008 and 5. That basically says if you agree upfront to make equity, to make the payments in equity, so you're basically doing a services for equity swap, then that is not claimable for R&D, and that's not tax deductible because it's not a loss or outgoing of the company. Now, that tax determination does go into a number of examples where sometimes it could work, right? And that is where the initial agreement, right, is not for shares in the company. But when it comes to settling that amount that is owed, it just happens, you know, the service provider might subscribe for shares in the company, and then you offset the two liabilities against each other as a constructive payment. Where that is the case, then potentially it is claimable for R&D and potentially it is deductible for tax. Now, that's a very complicated fact-specific scenario. So I would say in those situations, you need to do appropriate planning at the front end as well as relevant analysis at the back end, because there are other tax issues like commercial debt forgiveness that can kick in as well to depending on how much the shares are worth, how much services are worth. Grant receipts and clawback. Again, very relevant to this world because a lot of the times there are grants that are in play when you're making an R&D claim. There is a clawback mechanism, and the mechanism itself after the 2011 law changes are actually different now. So the way that it works now is it goes through a uniform clawback provision. Again, I'm not going to go too crazy going through it. It's very complicated. But what I will say is today, potentially you can still get the R&D benefit on your portion of a matched funding of a grant. That's the first comment I'd make. But secondly, the way the clawback cap works now, you've got to be careful because the cap depends on how much money you received or are entitled to receive in a particular year. So if you over receive an amount, then you potentially cop a upfront notional clawback on the portion that you are contributing, which then you can pick up later. So it's a very complicated scenario. If you're getting grants and you're claiming R&D, I would say speak to someone. The other point to make is in a grant receipt clawback scenario, because the R&D tax incentive turns your entire amount, right? So Serge touched on before, it's the corporate tax rate plus 18.5%, for example, for under 20 million. Right, it converts that entire corporate tax rate and the 18.5 into a refundable offset. So if you're in a loss position, right, you might get clawed back on the 18.5 incremental R&D benefit, but you may still be able to access a refund on the other 25%, which you wouldn't otherwise be able to get if you were not claiming R&D and you're in a loss position. So sometimes you can actually get a pretty big cash flow benefit from that perspective. Prepayments, again, very complicated topics. I'm not going to go into it too much, but typically for tax, prepayments are subject to you basically have to work out the service period and then you get a deduction along that period. There are certain rules that say you can pick up the prepayments at the point it's incurred if you meet those certain rules. So a lot of people either get tricked by that and go, oh, because R&D also sits in those prepayment rules, and we meet those rules, so we can just claim the prepayment up front. There's an extra bit for R&D that makes it tricky, which is the activity that you are claiming the R&D claim on, with notional deduction on, must be registered, right? It does say the incurred amount can be claimed for R&D if the activity is registered for any income year. So it doesn't say in the year, but in plain English, what that means is if I pay an amount today as a prepayment for activities for the next 3 months and then another 5 months into next income year, technically, I can't actually claim the extra bit of the prepayment until my activities are registered next income year, at the end of the next income year. Then I have to actually come back to this year and amend my tax return. Different tax agents have different, I guess, ways of dealing with this. I would say just speak to your tax agent R&D advisor on it, but just understand the risks with different methodologies. The last one is amounts incurred to associates. So if you're an associate of the company, which essentially under Division 318 of the 36 Act says, if you've got majority shareholding, right, or there's sufficient influence over the business, and you basically have to consider your family relationships all in a bulk. So if you've got multiple people with different shareholdings, but your family and you're related by blood, you got to consider that together. Where that's the case in your current amount, right, it has to be paid in the income year for it to be claimable. If it's not paid in the income year, then you have a choice, but the choice must be exercised by the time you lodge your tax return. The choice is you either carry it forward and claim it for R&D in the year it is paid, or you take a tax deduction for it in the year it is incurred. So you just give up the R&D altogether. Now, what I've seen some people do is they don't realize, and they go, I'm just going to carry this forward, but they don't do the tax return properly, and the amount is not added back. So they've inadvertently taken a tax deduction. And then they go, I'll just go back and amend that tax return to then make that choice, right? The law actually stops you from doing that. The legislation in this area says at the point of lodgement of that tax return, that is when the choice is made. You cannot go back and amend the tax return and reflect a different position. So again, if you've got associate payments, you're very careful with that. And then the last one is there's multiple entities in a group and there's cross charges. There's a taxpayer alert 2023/4 that outlines a lot of the tax office's concerns, both in terms of who is the R&D for, right? Is this a scenario where one entity, for example, a trust can't claim, so you've repurposed another vehicle to make that claim? Or is it a case where the different entities doing different things? If so, what's the arrangement? What I would just recommend there is, these days, I would say you probably do need agreements in place between the various entities. Gone are the days where you can say, I control the entity, so I, vouch that this is what happened. That's going to put you in a high risk scenario with the tax office. But secondly, if you're claiming R&D and there are multiple entities with IP holding entities and multiple entities incurring different amounts that you might be claiming, definitely speak to your R&D advisor and your tax agent, I'd say in the same room, just around whether or not there are any concerns that might be outlined in that taxpayer alert that might be relevant to you. Cool. All right. So I'll hand it back to you to go to the DGTO.
Cool. Thanks, Peter. Cool. All right, we're going to speed through this and then jump into an example. So basically, game studios, you've got your own tax offset now in the DGTO, but now we're going to talk about kind of where the R&D might fit in if you're already claiming the DGTO. So just as a brief intro, you're going to get a 30% refundable tax offset. So basically, this is going to work really well when you're in a tax profit position in particular, because that benefit, as we said, is only that 18.5% uplift, assuming you're under 20 mil turnover. Whereas if you're in a tax loss position, the R&D actually might be more attractive. And so we're going to show you how that example works. But basically, all I really want you to kind of understand from this slide is that there's a 500K threshold for the DGTO, so in all certificates. And there are some restrictions to the DGTO where the R&D might be able to capture. So for the example that we're going to run through, there's a 65K per year director cap. And so basically, this is for your influential employees. And so this could be a bit of a limitation, especially for smaller teams and founder-led studios, which is where the R&D could be such an awesome way to capture some of their costs. So I'm going to just go to the next slide. Peter touched on a lot of this here, like the clawback adjustment and all these other little considerations to make. Generally, my advice is if you are claiming the DGTO, it's always going to be a better option for you. There's less inherent audit risk. It's easier to do. But like I said, if you're in a tax loss, the benefit is going to be more under the R&D. So we're going to run through a little example. And so you're a 7-person studio developing a game called Tax World. It's a single player narrative game that explores Australia's tax system. I said here it could be fun, but please no one actually make this game. So the team includes a CTO who's also the director, a producer, a programmer, 2 artists, a game designer, a UI artist. Each team member earns 100K per year, so that's the salary. The project runs through FY25 and FY26, and the game is going to release at the end of FY26. So during development, the CTO and programmer dedicate their time entirely to building a proprietary game engine that transforms the legislative content into interactive narratives. Again, please no one actually make this game. The complexity and technical uncertainty involved make this work eligible as core R&D. So let's just assume all the time that the CTO and programmer are spending is R&D. So each year, the studio incurs 700K in salary costs. The DGTO is not available in FY25 because the game, under this example being the completion certificate in which the DGTO will fit, is not going to be available into the FY26 year. So let's also just assume all the expenditure here is available as QAID, which is the qualifying Australian development expenditure under the DGTO program. So I'm going to show you a big table. Don't feel overwhelmed. Feel free to screenshot it, whatever. But I just want to run you through a few examples where the R&D might fit in and make your tax offset better. So in scenario 1, we're only going to claim the DGTO. So forget the R&D for now. So you're not going to have a DGTO claim in FY25 because the game's going to release the next year. And in this example, we're not doing an R&D claim. So basically, your DGTO claim is going to be the 700K salaries for each year. So we times that by 2, so 1.4 million. But as you recall in that little example slide before, there's a director cap, which is the CTO in this instance, of 65K per year. So we need to, that's because that's the cap, that's the limitation. There's effectively 35K per financial year for the CTO that's kind of left on the table here. And so the amount ends up to be $1,330,000. So we're going to times that by the 30% refundable tax offset rate. So your benefit is going to be 399K in scenario 1. Now, scenario 2, we're going to assume this is the tax loss. This is so both years are going to be big tax losses, which are going to be losses more than the R&D expenditure in this case. So again, for FY25, we're not going to make a DGTO claim because we can't yet, but we're going to make an R&D claim. And we're going to make an R&D claim picking up both the CTO's time and the programmer's time because they were working on that engine. So 100K salaries each. So we're going to put in a 200K R&D claim for FY25. And we're also going to put in a FY26 R&D claim, again of 200K. The DGTO claim, we now have to take away the salaries for the CTO and programmer. So it's no longer 700K per year, it's 500K per year under the DGTO claim. So the reason for that is you can't claim the same dollar under both tax offset programs. So basically what we find here is a 200K R&D claim, 200K R&D claim for both years, and then $1 million DGTO claim. And the $1 million comes because it's 700K per year times 2, which is 1.4 million, minus the salaries here under the R&D. So what we find is utilizing both programs here, we're going to get a benefit of 474,000. So, you know, that's an extra 75K back in your bank account under the refundable programs. Again, we're assuming, I should have added here that it's less than a 20 mil aggregated turnover studio, which is for most of the cases. So this is scenario 2, the tax loss position. Now, scenario 3 is a tax profit situation. So for example, let's assume they released another game and they were just still getting continual sales from that. So again, FY25, no DGTO claim. But this time, we're not going to claim all the CTO's salary, and we're not going to claim the programmer's salary because the R&D claim benefit in this instance is 18.5% versus the 30% benefit for the DGTO. So, you know, if cash is tight, for example, in this instance, it might be better to put more dollars in your R&D bucket to get the money in FY25 as opposed to waiting until when the game's released. But for example, let's just consider that you're only claiming the 35K for the CTO, which is the amount that you're unable to pick up under the DGTO because of that 65K director cap. So we're going to do that R&D claim in FY25. We're going to do that R&D claim in FY26 also. And then we're going to put everything else in the DGTO bucket. So the DGTO claim is the same as scenario 1 here, but this time we're also picking up the money that we left on the table for the CTO under an R&D claim. And so in this instance, for scenario 3, we get a benefit of 429.5K. So it's an extra almost 30K back by utilizing both the DGTO and R&D. Now, 30K may not be material for your studio, but this could be half a junior salary in some instances, which is still a win for the industry. And so this is sort of the picture I wanted to paint. And I just want to hand it back to Jens here in case anyone has any questions or if Peter wants to add something.
Yeah, look, thank you very much, and thank you for that very comprehensive overview. And Peter, was there anything else you wanted to share before we give the audience an opportunity to ask some questions?
Nope, all good. I think
excellent.
It's very detailed what Serge has put up here.
Look, thank you so much for that really comprehensive, great overview and touching on all these points, eligibility, myths, why studios may be reluctant to claim, and the relationship with the DGTO. So I can appreciate there's a lot to digest for our audience, but maybe there is some people here who have some questions. If you do, feel free to put them in the chat. You're also more than welcome to unmute yourself, put yourself on camera if you want to ask them in person. So, maybe digest what you've just heard. In the meantime, maybe I can start the conversation. Serge, we've heard sometimes that there may be sometimes a bit of an inherent conflict as to how games are made and the R&D incentives, in the sense that, in games you have a very creative, iterative process. You may not immediately document everything, yet that is somewhat the expectation of the R&D incentive. So there may be, I don't know, it may be tempting to retroactively fit the documentation to the process. What's your experience with that? And to both of you.
Yeah, quickly, I can just say that a lot of game studios definitely rapidly prototype. They jump from one idea to the next, or they can just discard everything really quickly. But usually, and this is one of the differences between kind of being a business and what the government wants to see under the R&D, is that they really like to hear about failures, and failures is such a great thing to write about in your R&D. So if you have, ideally at the end of the day, you have commercial success, but if you're having failures internally as a studio, I would always put that down as in a little memo or in a little email, and have it as like, here's an example of some R&D we did. And over the course of the year, I'm pretty confident your studio is going to have a lot of these. And then we can then consider like maybe looking at, similarities between all your R&D failures and putting in an R&D claim for this.
Yeah, I'll just add to that, Jens, and sort of firstly spot on that gaming business is typically, creative in what they're doing. But I will also say, in all of my experience with gaming businesses and studios, the way that the project proceeds, right, there is actually a pretty strong software engineering side to it. I haven't seen a single one where it's a creative only and then it's very standard software engineering. And in particular, because the technologies underpinning gaming are so specific, right? So if you compare that to, say, fintech, which I do a lot of work with, there are a lot of open source available tools there. So you actually might run into the risk that actually people in that industry should know how to utilize those tools. So in gaming, I actually think if we turn our attention away from the creative work, right, and to the more technical work, then that's where you start with the R&D claim, and then some of the creative work can come in as a supporting activity potentially if it impacts the design. And then the second thing on documentation, again, is in a gaming scenario, I haven't seen a single company that has no documentation, right? Just the very nature of what you're tracking, there is documentation. It's just about how we come in and help rejig the wording sometimes, and that can be learning experience going forward. And very rarely does it take a long time. It's just when people are doing their original documentation, if they just tag it with R&D or add an extra line or do a search, send an email to someone to just say this is a technical challenge I encountered or a failure or whatever, then that's it. One more thing I'll add to it is, like I said before, DISA and the ATO are very open to collaboration these days, right? So I've actually had companies, if you're really worried that there's high risk, they're happy to come out there in the first instance, have a look what you've done, and directly tell you, right, in our expectation, this is the gap you've got at the moment. We would be happy if you put in a claim for this bit here now, but going forward, if you address that gap, that's fine. And then if you really want formal, I guess, approval, we talked about the overseas finding before where there's a formal approval, but the R&D program actually also has a formal approval process if you want to access that. In the year, you can actually formally submit for yourself to be examined, right? And if you are going down that path, they can actually give you a legal, this is going to qualify. And if they do give you that, you can get up to 3 years of certainty. Now, most people don't go down that path because it's costly potentially. You potentially risk, in a self-assessment scenario, you might get through, but you put it forward, you get knocked back. So now you've just lost your R&D claim unnecessarily. Whole raft of reasons. But for people that actually want to test that out, there's formal and informal pathways to testing that out with the regulators.
Yeah, good to know.
Yeah.
All right. Well, thank you for.
I think we got a question.
Yes, we do. I was just want to say that
Yeah.
that's the question from Aaron is, and I don't know if you're the right people to answer this, but the question is, can the R&D application be completed without a consultant to assist? Because the DGTO is much simpler. It can be done in-house.
I have an answer to this. So basically, yeah, the DGTO is definitely much simpler, and I'm not just saying this because I'm consulting in this field, and I know Peter can definitely vouch for this, but there's a lot of power in preparing the DGTO and the R&D together, especially when it comes to cash flow. And so there's a lot of power in being able to put together a workbook and say, oh, actually, we can fill up our R&D bucket a little bit more and access the cash now instead of waiting for the game to release. Or maybe it's like worth putting in the DGTO bucket more. And running this scenario with studios, there's a lot of value add there. And often the value add is material in cash, which covers more than the R&D consultant fees. And like we ran in that little simple example before, you're going to get more if you do both programs. And I definitely recommend just always having that conversation. Whereas maybe just have an upfront conversation with an R&D consultant to say, hey, this is what we've done. Usually when you claim the DGTO, do you think there's an avenue for an R&D claim here also? And if there is, it's best to prepare those workbooks together because it's a lot of, to avoid all that double handling.
Yeah, that's a really good point. And I think just to add to what Serge is talking about in terms of maximizing their value, right? Even DGTO, companies I've assisted with versus their initial draft they prepare, the amount of, I think things on the fringes or edge cases that people don't realize because you're not dealing with the law day in, day out and the regulators, you're missing out on a lot of money, even in the first instance. Now, the second comment I'll make on that is it again doesn't have to be a do-it-yourself or get an advisor to do it. There is a middle ground. So ultimately what you're balancing is you're the taxpayer, right? So you've got tax risk. Then in the R&D, you're potentially getting a refund. So you've got that opportunity cost of, are you maximizing your R&D claim? Then you've got consultant fees, right? So amongst those three things, you can decide, I'm going to do it all myself, but you might be losing value. It might be high risk, gets overturned later. You cop penalties on top of that. You might go straight to an advisor and go, you do everything, right? Then you might pay a little bit more, but you're maximizing value and you're minimizing the risk. Or you could do something in the middle and say, hey, look, I'm going to do the first cut myself, right? And then you can, for a lower fee, have a look at that for me and give me comments. That is fine too. There's three different options, I think, there, rather than just looking at it as a, one or the other.
Yeah, good point. Look, thank you very much. And, I guess you got to spend money to make money. And it's one of those cases where sometimes the specialist pays for themselves, lawyers being another example. If you're unsure about something, better consult a specialist because it may save you some money in the long run. We do have another question from John, and that relates to how much additional documentation would you expect to be needed for the general production work of a game? For example, source control commits and conversations in Slack already extend artifacts of doing the work. Are there any examples of additional documentation you'd expect to be needed for game development to work to help solidify a claim?
I can jump in here again. And so, John, basically, there's no perfect world, but it's really, you just want to show that contemporaneous nature. What I really like to tell studios is, at the start, have an R&D plan. That goes a long way just to put down your thoughts. Number two, do screenshots of your Google searches, download literature reviews, at the time saying, or maybe just show what another studio is currently doing, and screenshot with the little timestamp down the bottom of your desktop. That goes a long way at the start in particular, and then just have a regular kind of a periodic R&D check-in. This could be embedded in like an executive team call every month or whatever. You just have an agenda item that says R&D, and then under that just have a few dot points. The other point I raised before is like, just flick your R&D consultant or advisor emails whenever you want. Just CC them or have that traced. At the end of the day, there's a lot of different things you can do, but I think just being intentional about the way you keep R&D documents is probably the best thing. Because if you go into a review and you are upfront with how you're keeping these records, the assessors are immediately less aggressive.
Yeah, I completely agree with that. The one thing I will add is, again, a lot of people look at this as, I've got my current processes, so that's state A. If I claim R&D, I have to go to state B, where we have to spend, weeks and weeks and weeks and weeks to create additional documentation. The myth to bust there is that's actually not the case. A lot of what Serge just talked about, in a quarter, it might take an hour. 1 hour a quarter will change your risk profile from a 90% risk to a 10% risk. So it's not a time thing. But the second point, as Serge just touched on, is this is a tax law thing. So there's specific keywords, again, that Serge outlined before in orange font. If you get a review, the reviewer is looking at, as a layperson, they're not going to a lot of time be an expert in tech even, right? They're just a layperson with a checklist that says, is it a systematic progression of work, right? Then when they look at your documentation, this is where some people are stubborn and go, I'm not creating a new documentation. They might have a lot, but then they dump all the source code and the iteration of source code. Now, the layperson at the government sits there and they look at it and they go, I cannot, as a regulator, tick that off and say you meet the criteria, because I have absolutely no idea what this is saying. So all you'd actually need to rejig that is in that quarter, like literally add the systematic progress or annotate that document and say systematic progression work is outlined below. In layman terms, what is happening below is this, right? That takes 30 seconds, but allows them to tick that box, right? So that's probably the point I'd make on that. The other thing just to really quickly mention is, as we said before, the R&D tax is a self-assessment program. So you submit it. It's not like the DGTO where someone audits it and looks at it. It gets a cursory review in the first instance. And then if there's problems subsequent down the track, you might get a review. The review rate is actually not that high. So I was sort of, in my experience in the last 8 years of doing this at RSM with almost 400 clients, I think I've had 2 where we've even had a question or a letter to say, can you clarify a bit further, right? So that is a very small percentage that actually goes to a point where you need to provide this extra documentation. So it's certainly not a case where, you have to spend weeks and weeks and weeks getting ready for an audit of the R&D claim. If you get a good advisor, the review risk is actually relatively low. Yeah.
Excellent. All right, look, I'm sort of mindful of time because we have got a little bit over time, but thank you so much for all your explanations. Now, before we finish this, if you watched this and thought, wow, this is all very interesting, but I would really like to explore this in my own time, we have a upcoming service for a GM member for you that will allow you to just that. Allow me to just present my screen here. I hope you can see that. Just bear with me. We are going to release today to our members the so-called IGEA Academy. The IGEA Academy is a learning resource designed to empower game developers with the essential skills and knowledge to run a game studio, and R&D is part of that. This content has been created by our members. We've crowdsourced a bunch of knowledge from our network, from the AGIA network, to make it available to the benefit of the rest of the network. R&D is part of that. If you can see this here, you can see this is a course on financial basics presented by LDB, another AGIA member in RSM, and you can explore all of this in your own time, in your own pace. It talks about the incentive, the myths, the eligibility criteria, and so on. The AGIA Academy is going to go live today, exclusive to AGIA members. We're not going to just feature things on financial basics. There'll also be information on games and HR, games and legal basics, games and investment, and games financing, as well as a production 101 and starting a game studio as a business presented by our own members, Noble Steed. So there is some good content there. We will release this today to our membership. We'll also announce it in our newsletter. So hopefully this will be useful for you and allow you to explore this in your own time. Thank you very much, Peter, for preparing all of that for the AGIA Academy. I'm very much looking forward to our membership engaging with this. If you have any suggestions for content you would like to see in the future, by all means, let us know and keep your eyes peeled. If you're not an AGIA member, I'd like to take advantage of that, feel free to reach out to me. It's my first name, jens@agia.net. So Serge and Peter, thank you very much for joining us today, for walking us through the R&D incentive. At the surface of it, it may seem somewhat complicated. I think once you do a deep dive, it's like, oh yeah, I get it. Because, I mean, I've done all of the translating, Peter, of your resources for the AGIA Academy. So I went through all of them. It's like, oh yeah, okay, that makes sense. So, it's not magic, and if you feel that you are struggling, there is help here in the form of RSM as well as Playwright Consultings. They can walk you through it. As I said before, it really pays to engage a specialist in the field to make sure you're on the right track and allow you to maximize the benefits. So thank you all for joining us today. Thank you also to the audience for sticking with us, and have a good day. Thank you, and see you in the next webinar. Take care.